Hey everyone, welcome to Dividend School. Today we're going to talk about I rank the Mag 7 dividends, and this one is the best. Amazon and Tesla pay nothing. Of the five that pay, only one is worth holding for the dividend. So let's dive in. So first, let's take a look at the field. Amazon and Tesla, they don't pay us a cent, but we have Microsoft, Apple, Google, Meta, and NVIDIA, which surprised me a little bit. All five of those companies picked to the first. And a little tidbit, one of these growers is faking his number, and the winner isn't even close, in my opinion. All right, so big reveal, number 5, NVIDIA. So this has a dividend safety score of 4.0 out of 5, so very strong. The payout ratio and for earnings and free cash flow are minuscule at 1%. Awesome. Interest coverage 503 times, so very well covered, and has return on capital of 135%. So this is a very, very strong business and it is functioning it's hitting on all cylinders. So the business is bulletproof for sure. The dividend really just isn't the point, as we will see here. Yield 0.02%. So that is minuscule. The company is going to pay you a whopping 4 cents to own a share of NVIDIA for the dividend. They have a 2-year streak. So on $10,000 invested, that's around $2 a year. So that's not really a yield you're going to feel much. You are not owning NVIDIA for the yield. This is definitely a capital appreciate or share appreciation story for the company. A dividend is more of an afterthought. They are paying a 5-year, a 20% revenue or dividend growth rate over the last 5 years, which looks impressive on a number. But when you consider that they cut the dividend in 2024, it's not really much of a streak. So you would definitely want to own NVIDIA for the growth of the share price, not for the income at this point in their evolution. So let's move on to the next one, Meta. So Mark Zuckerberg company. So we got a dividend safety score of 4.0 out of 5, obviously very strong as well. The dividend payout as well as the free cash flow payout ratio are both outstanding at 9 and 10%, which you would expect for a company that is extremely profitable like Meta is. It has zero net debt to EBITDA, which is awesome. And free cash flow is 46.1 billion. So again, very, very strong. This company is very safe on the numbers, but it just hasn't proven the dividend over time. The yield is extremely low at 0.32%. So that's not much to write home about. It is paying you $2.11, which is way more than NVIDIA was paying you. But the streak is very, very young. So this has a real payout ratio of already of $2.11. So that is real income, but it only has one raise under its belt. The raise was 5.5%. So not super huge. But again, this is a new dividend payer and they're new into uh, returning capital in this way. Zuckerberg has been returning capital via buybacks for a few years now, but there's a lot of cynicism around that it's more to offset the share dilution that he's also incurred during the same time. There's also been a lot of cynicism around the company just in general because of the AI play and the money that they've committed to spending, not only for the data centers that they're building and the platform that they're building, but also the talent that they've been hiring to try to be an AI winner. And returns are still too early to tell on all that spend, but that is something that is definitely weighing down on the company as far as the share price goes, as well as sentiment. And we might probably start to see some of that impact the financials in the next few years. I think the AI spend is going to dwarf the Reality Labs spend that people were really upset about a few years ago. So it'll be interesting to see how that plays out. Number 3, Alphabet, the Google machine. So this is a 4.2 out of 5, so a very, very safe company as well. This has some of the lowest payout ratios on the board, and it has a very, very strong balance sheet with no net debt. So the dividend here is very, very well protected. It has a 12% free cash flow payout ratio, a 7% earnings payout ratio, no net debt, and returns on capital of 32%. So again, bulletproof coverage. The only question is its age. So yield Yeah, not much to write home about in the yield. This is even less than Meta was. So 0.23%. They're paying you 83 cents a year to own a share of Alphabet for in dividends. So nothing to get super excited about. And the streak is about a year and a half or so. So the takeaway is very tiny dividend, but the 7% payout ratio means an enormous room to grow. Alphabet is a company that I do own in full disclosure, and it is extremely profitable business. Their ads platform has been very profitable, as well as YouTube, which you're watching this on. And those have been very, very strong platforms for the business. The dividend is a new part of capital allocation and is exciting to see. They do have quite a bit of cash on their balance sheet, which makes it a very strong balance sheet, but it also kind of drags down the overall returns that investor could see. So it's exciting to see them start to initiate a dividend. And we'll see how that goes. The dividend growth is kind of not non it doesn't really stack up, kind of like Meta's. It's so new that it's really kind of hard to judge the dividend growth at this point. This is something we should revisit in 5 years and see how they're doing. It has a very tiny payout ratio. It's probably the safest newcomer of the bunch, and it has a fortress balance sheet. It's promising, but it's only a couple years of paying, so we'll kind of see how that goes. Uh, Number two, Apple. So Apple is a real dividend stock. This has a very safe payout, 4.6 out of 5. So it's very, very strong, low payout ratios, has a very clean balance sheet, and has a reliable 14-year raise record for the company. So the dividends for this company are extremely well protected. The free cash flow payout ratio, as well as the earnings payout ratio at 15%, those are outstanding. Return on capital at 48%, and a dividend increase streak of 14 years. So that is awesome. This is definitely a dividend grower, and it is a real dividend payer with a 14-year track record. The yield right now is not anything to get super excited about. As we can see here, the 5-year average is 0.5%, which not awesome either, but it's certainly higher than it is right now. Because the company does see some volatility in the price, you are going to see the yield kind of fluctuate from time to time. Right now, Apple is paying you $1.03, $1.03 to own a share of them in dividends, and it does have a 14-year streak of the company, so it does have a real rising payout, and the yield is just held down by the share price right now. As we can see, the dividend growth is less than probably you'd like to see. This has a 4.9% dividend growth. For a company that's yield is not real high, to see a lower dividend growth rate is also not exciting as well. So if you compare this to a company like maybe a MasterCard or a Visa, they see much higher dividend growth rates than those companies for their low yields as well. They're both less than 1%, but you're seeing dividend growth rates for those companies of in the neighborhoods of 15 to 20% annually. And so that makes them much stronger dividend plays than a company like Apple might be. So this is a real dividend stock, like I mentioned, but the growth has cooled to about 5%. So this makes it a dependable number two. Another side note about Apple before we move on to the big reveal and the number one stock in the Mag 7 is Apple has gone through when Cook took over in 2014, or I'm sorry, about 14 years ago. He started instituting a buyback program as well as paying a dividend. And the while that was awesome because they had a ton of cash on the balance sheet, and there was a lot of conversation in the market about what they were going to do with all that cash, because at that point the iPhone was still newer, obviously, but it has since slowed. The growth of the iPhone and the iPad and some of their newer products have slowed, and the company is also considered an AI laggard. And so there's been a lot of conversation about what are they going to do with all the money they make. And so Tim Cook instituted the buyback, and that was a fantastic deal for shareholders because he returned a ton of cash to shareholders via the buyback and reduced the share count tremendously, and also paying a dividend. So, in combination of two of those things, it helped really juice the returns. And Warren Buffett was a huge Apple shareholder for a while now, and he bought it when it was extremely undervalued, and he kind of caught the wave really well, and it grew to be roughly 50% of his portfolio. So I want to say in 150, 180 billion range to own the company. So that's that's quite extreme. Anyway, all that being said, the company has done really, really well. It's been a great investment for a long period of time. But one of the concerns is that the buyback and the dividend are slowing because that cash pile has dwindled quite a bit. And because of that, now they're gonna have to start relying on the profitability of the business, which while is really, really great, the dividend growth, or I'm sorry, the revenue growth has also slowed dramatically over the last 14 years. And so there is a lot of concern about where that growth is going to come from. And because of the companies that we're talking about today, they are definitely the AI laggard. And so it's going to be interesting to see going forward how this company does with dividends and buybacks in the future. So now we can go to number one. Da, 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 da. So here's the big reveal. We got Microsoft. So Microsoft is the number one dividend stock in the Mag 7. So dividend safety score of 4.8 out of 5. That's kind of ridiculous. The company has low payout ratios, a clean balance sheet, and it has a reliable 19-year raise record. So the dividend is unquestionably very well protected. You see a free cash flow payout ratio of 29% and earnings payout ratio of 25%. Again, anything under 60 is outstanding. So these are very, very low. It has no net debt and has returns on capital of 27%. So this has the highest dividend safety score of the Mag 7. The yield, while not outstanding, if you wanted to compare it to, let's say, a Johnson& and Johnson, for example, 0.84% is easily the highest of the Mag 7, and it's almost double, uh, yeah, double or triple the other players. Now it is tiny comparatively, and you will see the yield fluctuate because the stock price is going to fluctuate quite a bit. The company does pay you $3.24 a year to own a share of this in dividends, and again, it does have a 19-year streak. So that is really outstanding. And if you look at the 5-year dividend growth, it's 10.2% over the last 5 years annually. And so that's double Apple's. So that is fantastic. And actually, if you look farther back, I believe it's 14, no, 19 years of dividend, 10-year plus dividend growth. So this is a very strong dividend paying company. And the yield on cost on this company for the dividend is going to be very, very attractive. And so that is definitely something you want to keep in mind when you're looking at this business and you're trying to decide whether it is something you want to invest in or not. So let's look at why Microsoft is the big winner. So if we look at the kind of the scoring, if you will, dividend safety 4.8 out of 5, again, outstanding. And this is the highest of the group. The yield 0.84, while maybe not Johnson and Johnson or dividend aristocrat levels, it is easily the highest of its peers in the Mag 7. 5-year growth, 10.2%. So that's about twice Apple's pace. And the dividend streak is 19 years, which is easily the longest by far. So this is the only company out of the five that's in the top two in safety, yield, and growth. And it has 19 years of raises and no net debt. So this is the clear winner for the Mag 7 for the investments. If we look at the overall scorecard of the Mag 7, we can see that Microsoft came in at 4.85% with a yield of around 0.84%. 5-year growth, 10.2%, 19-year streak. We went all over all that. If you look across the board, the dividend safety for all these companies is all very strong. The lowest ones, air quote, lowest ones are 4.0 out of 5, which is outstanding. And so these are all very strong quality top-notch businesses. They're very profitable and have been for many years and will be likely for many years to come into the future. The yields are less to be achieved, and that's not great. And the dividend growth, for the most part, is kind of too early to really judge conclusively at this point, other than Microsoft and Apple, who have real dividend streaks. The other companies are new payers, so it's really hard to compare apples to apples with that. One note on the yield and maybe what they're paying out. because these companies are all in uber growth mode right now, dividends for the most part are not really a large part of their equation quite at this point. Capital allocation is job number one for CEOs, and these all five of these companies have outstanding CEOs. They're fantastic, top of their game. And you think about some of the best in the business, and all five of these can easily be in the top 10 of that group. And so, but that being said, they're spending the vast majority of the money they make on AI right now, either building out data centers, building out designing chips, uh, building out new platforms, building out new programs, all these different things that are AI related. The vast majority of their money is going to that. At some point, that will slow. At some point, these companies will start to air quote mature. Not that they're, any of them are young uh, by any stretch, but at some point they will start to slow down their growth and some of those kinds of things. So that being said, they will have more profitability because that will probably not slow down for quite some time. And because of that, they will have lots of room and lots of cash to start pay a growing, stronger dividend as the years go by. So these are definitely companies you want to keep on your radar as future dividend payers and dividend income stocks. None of them would really be an income play at this point. If you were going to invest in something like a Microsoft or an Apple as an air quoted dividend play, I would probably have it as a smaller portion of your portfolio, simply because their yields are a lot lower, but they do have a longer runway to grow. Whereas the other three, Alphabet, Meta, and NVIDIA, would probably not fall into that category. If you're going to invest in these companies, by and large, you're really looking more for the share appreciation because of the strength of their businesses, not necessarily the dividend returns that you would expect to see from those companies. So if you own the Mag 7, you own one fantastic dividend. And I hope you enjoyed today's show. And I hope you enjoyed the conversation about the dividends for the Mag 7. And again, none of these are really dividend play, or I'm sorry, income plays, but they could be potentially. And it's always good to look around and keep your eyes open for the next great dividend stock. If you enjoyed today's show, please subscribe to the YouTube channel at dividend.school. And with that, we'll see you next Tuesday.